Welcome back to my channel. I am Christy Vann with Fantastic Finances, and on this channel, I teach velocity banking. But today we're going to be having a discussion about infinite banking. I have Chris Naugle with me. So excited that he is on here because he's going to answer all the questions that you guys have been sending me that you want answers to. Now we're going to have the expert tell us exactly what we can do with our money, whether that be before we start velocity banking or whether that be afterwards. We're going to learn all of that. Welcome to the channel, Chris.
Hey, thanks for having me on again. Really excited to be here and to get back to the basics of IBC.
Everyone is so interested in what you do. I believe I talk with you to everyone on every conversation that I have. Seriously, everyone wants to know what to do with their money. And I know that you're the only one that can answer the questions. So if it's okay, I'm going to ask you a few questions that I've been getting, and then you kind of fill in the gaps there and help us to understand exactly what we're doing when we do infinite banking.
Absolutely. Let's go.
How much does it cost to start an infinite banking policy?
Yeah, I get this question all the time because, people see the videos, they see the dollars on. I've even had people be like, oh, that's only for the wealthy, because they'll look at a video that we're showing 100,000. But really, the truth is the minimum would be 10 times your age if you're between 30 and 60 years old. So anyone that's 30 to 60, what I want you to do is just figure out your age. Hopefully you know what that is. I'm 46. So if I had a zero after my age, that's 460. That 460 would be my minimum monthly to start this policy. Now, if I wanted to go annual and I wanted to put money in one time a year, I just multiply that times 12. Now, if you're under 30 or over 60, it's 15 times your age. So you just do your age times 15, and then that's it. And that's your minimum monthly for how to start this. And it's really where this comes from is it's not like it's some amount that's a minimum with the insurance companies, but what we've found by doing this thousands and thousands of times for people is if we do any less than that, we're really hurting, our member. We're hurting our client because we're not giving them enough to really make a difference. So if somebody can save 10 times their age, then we're in business or more.
Okay, that makes sense. Another question would be, can you have this on your children?
Oh my gosh. Yeah. So you could do this on your children. I mean, I got a personal example. So my daughter, when she was born, she's now 3, but when she was born, at 6 months old, I started her first policy. Now, for children, the thing you got to understand is there are some rules. So I could not open a policy on my daughter if I didn't already have coverage on myself. And it's really an ethics thing. Think about this. The insurance company would ask the question of, if a parent, the husband or the wife were to say, I want to do a policy on my children. The insurance company is going to say, okay, how much coverage do you have on your life as the breadwinner? And if you said nothing, they would never allow you to insure the child, because the insurance company is looking at it saying, what don't we know here? Why do you want, insurance on your child and you have none on yourself? Now, the only acceptable answer there would be if the parent is uninsurable. If the parent is uninsurable, then that's kind of like a hall pass. They then can open a policy on a child. But back to my daughter, Vivi, when she was 6 months old, I started a policy for her and I did $5,000 a year. Again, you could do any dollar amount because remember the rule is 15 times age. So I could have gone much less, and I probably would have maxed out for my daughter somewhere around 30,000 a year would be the most you'd be able to put in for a child. And unless you're extremely wealthy, it would be hard to get more than that in for a child. But here, let me tell you the reason I did this. Okay. First off, I wanted to make sure that Vivi would be, able to have coverage. I wanted to make sure that she would have a death benefit, because a lot of times children, like, hey, listen, as much as I don't want to admit this, sometimes, there are childhood diseases or childhood things that happen that prevent them from ever being insurable. So I wanted to make sure no matter what, you're always hoping your child's going to be healthy, forever. But if she wasn't, I wanted to get that out of the way. So by putting that $5,000 a year policy on Vivi, even designing it the way we do for the infinite banking concept, which is different, it still gave her over $1 million in death benefit. But that's not the sole reason. That was just one of the reasons. The reason I'm going to do this for Vivi is I want to teach her how to become the bank. And there's no better way to teach a child how to be the bank as to do it right when they want to buy something. Now, in the video that I do for my daughter, and it's on all our emails, it's on my YouTube, I show how this policy, this one policy, will take care of Vivi's college. Okay, so it'll pay for 4 years of college. Then it'll pay for a down payment on a house. Then it'll pay for her wedding. Then it'll pay for her kids' college. Then it'll pay for her to get $90,000 tax-free per year for the rest of her life, starting at, I believe I started her at 60 years old when she retires. So it'll provide a supplemental retirement income of 90 grand per year until she's, I just have it at 90 years old. Now, the sum total of the numbers are, she puts in, I think, gosh, I don't remember the numbers, but puts in a few $100,000 over the course of her life into this, takes out millions of dollars, and still has millions of dollars in the policy that could have been used. So any of the numbers in the example, she could have taken out more. And let me go to one example. Most children, when they're 16, they're going to want to buy a car. I remember how excited I was when I turned 16. I got my driver's license and I wanted a car. Now, I had saved up $500 to buy a car, and that's all I could do. But Vivi, by the time she's 16 years old, will have over $99,000 in her policy. So think about that. A 16-year-old's got 99 grand that she could go buy a car. I mean, my gosh, she could go buy a used Porsche if she wanted. But I'm going to teach her that that's not how money works. So she cannot buy a $90,000 car unless she can afford the monthly payments on a $90,000 car. Because what we teach is how to be the bank. So if she were to buy a car for 90 grand, we're going to calculate, and I'm going to teach her how to do this. So think of this as I'm walking my daughter through the process of her being the bank. She wants to buy a $90,000 car. She identifies one. She's so excited. It's a, let's just say it's a red, a Jeep Wrangler. I don't know, just pick a car out of the sky. And let's say it's $60,000. So what we're going to do then is we're going to go into a financial calculator and we're going to figure out what the monthly payment would be if she were to finance that red Jeep through a regular banking institution. So let's just say that Jeep would cost her $750 a month at whatever interest rate, is the prevailing rate at that time. She's going to have to then understand that she's got to make a $750 a month car payment. But what I'm going to teach her is, listen, you have your own private banking system, sweetie. So we can take a loan from your banking system and we can buy the Jeep, and then you can make $750 a month payments, the same amount you would give to any financial institution, but you can make them back to your policy. And what will happen is after the term, let's call it 60 months, you will have gotten all the money back for that first Jeep that you bought. So then your next vehicle will be able to be whatever you want because you've gotten all the money back. So now you can sell the Jeep. So let's say the $60,000 Jeep can be sold in 5 years for 30. You got $30,000 plus all the money that you got back. So now you can go and repeat the process for your next car. So through life, you get to upgrade your life, not because you worked harder, longer, or took on more risk, but because you understood how to take back the banking functions in your life. So just take that example I did with a car and anything she wants to buy through her life, whether it's a house or college. We have to finance everything for the most part. That's what we're taught to do. Finance college, finance cars, finance houses. She's going to learn how to finance things, but finance them through her own banking system. And she's actually going to probably look at all of her friends and her peers and say, you guys are crazy. You're writing checks to that bank. Why don't you write checks back to your bank like I do? And people are going to think she's crazy and she's going to think they're crazy, which is going to be a whole nother thing I'm going to have to cross at that time. So those are just some of the examples of doing it for a child.
So when you make those deposits into her account, you do that on an annual basis, not a monthly.
I do, but I could do it any way I want. So the mode of premium deposits can be any way you want. You can do it monthly, quarterly, semi-annually, annually. It doesn't matter. You can make deposits into your banking system any which way you want.
Okay. So if I were to deposit 10,000 today, how long does it take you to be able or eligible to take withdrawals?
Yeah, well, withdrawal would be the wrong word. You could take a withdrawal, but that's not what we teach. Because if you take a withdrawal, you're reducing the amount of money you have in your policy, which reduces the amount of interest and dividends. So the way we do it is we actually take loans. So the insurance company, as per the contract, will allow us to take loans from our policy anytime we want for anything we want, up to the amount of cash value that we have or the savings amount we've saved in our banking system. So when I take a loan, the coolest part about using these specially designed whole life policies is the loan is actually in advance of my death benefit. The insurance company is loaning me money from their general account, but really what they're doing is they're giving me part of my death benefit now before I die. And then they're using my cash value as collateral. So what that does is it allows my money to stay in the account, earning guaranteed interest plus dividends on an uninterrupted compounding basis while I get to use the money. So literally I get to save and spend at the exact same time without interrupting any of my growth pattern. So that's the coolest part about this whole thing, is how it works. And, when you think about a bank, how a bank operates, and folks, all of you know how this works, is you put money in a bank, you make money and you put it into the bank, and the bank pays you interest on that. Now, whatever the interest rate is, it is. I mean, let's call it 3% by today's standards in 2023. They pay you 3%. Now, if you go back to that bank to take out, let's say, a car loan, how much are they going to charge you on that car loan? Well, it depends, but let's call it 8%. So they're paying you 3%, but they're charging you 8%. What are they making in the middle? A spread. So now that I change the dynamics by changing where the money goes first, by putting it in a specially designed whole life and creating my own banking system, if you will, I literally am the one making the spread, because now the insurance company pays me interest and dividends, which is more than the interest they charge me on the loan. So just using math, if I make 5.5 and they charge me 5, I make a spread instead of the bank making the spread. But every year my spread gets bigger because simply mathematics, my compounding nature of the cash value, every year that cash value is earning interest on the interest it earned the prior year. So my spread every year goes up. And again, I'm just going to repeat it. I didn't have to work harder for that. I didn't have to work longer for that. And I didn't have to take on any additional risk to do that. It is simply mathematics.
Okay. So a question I get a lot is, why would the infinite banking policies be safer than putting your money into a bank just in a basic savings?
That's a great question. And there's several reasons it's safer, but let's just hit the low hanging fruit one. And that is that when you put money in a bank account, it truly is low hanging fruit. And if somebody were to be over your house running around, they tripped and fell and they sued you, they're going to get paid out by the insurance company. But let's say they sued you for even more. Then what is the attorney going to come after? The low hanging fruit. So that would be your bank account. When you put money in a policy, it is protected against judgments and liens in most states. So to say that this is the highest hanging fruit, that is correct. Matter of fact, it is almost untouchable in almost every state out there. And you can do a Google search to figure out what states have challenged this. But, I always reference back O.J. Simpson, for good or for bad. We all know, he did or did not do some terrible things. And he's been sued. I think he might still hold the record more times than anyone else. But if you look at it, he is still a multi-millionaire. So how can that be? Well, it's because his assets were put into these type of policies where it was protected against judgments and liens. So that's the first protection. Secondarily, I love when people are like, yeah, but my bank account's got an FDIC guarantee. Woo. There's a lot of ways I can answer this one, but first, people really should just do a little bit of a Google search on FDIC to see how secure that really is. Because if you take all the deposits, I did a YouTube video on this, all the deposits in the United States, and you compare that to how much money the FDIC actually has, it's like a fraction of a cent for every dollar you put in. It might even be that much. I mean, I don't even know how you divide it down as much, but there's just not enough money in FDIC. Now, others would say, yeah, but the Fed will just keep printing money like they just did with Silicon Valley. Yeah, until they can't get that story through anymore, because eventually somebody's got to pay that bill, right? Oh, it's not going to be the taxpayers bailing out these banks because remember, they paid above and beyond FDIC guarantees, but then they said, oh, the taxpayers won't have any burden on this. That's not true, because what they did is they increased the insurance premiums for banks, which basically means the fees the banks charge will probably go up in coming years. But really, protecting against judgments and liens, understanding FDIC and how secure or unsecure it really is, and then looking at insurance companies. Insurance companies are not fractional reserve like banks are. So insurance companies, if they promise a $100,000 death benefit, they have to have $100,000 in assets. It's called Austrian economics, a dollar for a dollar. So insurance companies can't make money out of thin air. They can't just create this fractional reserve banking type model. So insurance companies have and always will be the most secure financial institutions because they truly have the money. They actually have the assets to support and back up and guarantee everything that they promise. I mean, in its sheer nature, that's what insurance companies are. But then there's still that odd person out there that says, oh yeah, but what if they run out of money? Okay, find me one example in history where that's happened. Some people will come back and say AIG during 2008, they went bankrupt. And did any of their insureds or any of their policyholders lose money? Even though AIG is not a mutually owned insurance company, so we could never use them. They're publicly traded. Nobody lost a penny. And that's because there's federal and state protections, kind of like FDIC, but in the insurance world, it's different. So there's never been a time in history where anyone's lost money because of an insurance company going belly up or going bankrupt or going insolvent. But I can certainly tell you throughout history, there have been more than I can even discuss times that people have lost money having money in banks. So what's safer, banks or insurance companies? Do your research and you will land at insurance companies over and over again.
Right. Okay. So I currently have policies with you. Very, very tickled with the way they were handled. So quick to get processed and make deposits. But I do have 4 IUL policies that I ran into before I came up on your channel. So tell me, can I use the IUL just like you have set up with the whole life?
All right. So this is a very controversial topic. I think up to date, I think I've done 6 videos, discussing this. And not only that, just to paint the picture, I have done more research on this single topic, this single product called Index Universal Life than I've ever done in my entire professional career. So when it comes to IULs, I understand them upside, downside, backwards, frontward, however you say that, but I definitely know the product well. The question comes down to, can you use an IUL for the infinite banking concept? The truthful answer would be yes, you can. But the second part to that question is, will it work? The answer is usually no, because there's surrender charges. So your IULs, which I believe I've looked at, they have surrender charges. So one thing that they don't often tell the clients is the bad sides of IULs. IULs are built on a universal life platform, which means there's a couple of things people need to understand about these policies. First off, every one of them, even if designed for the maximum cash value, every one of them has what's called a surrender charge, which, can be a varying amount of years, anywhere 5 years, could be as much as 10, where what you have in cash value, or they call it accumulation value, and what you can actually take are 2 different things. So riddle me this, with the infinite banking concept and everything we teach, it's all about putting money in the policy and immediately, and we often teach in the first 30 days, immediately taking a loan from the policy to make that money go to work, paying down debt, buying cars, investing in real estate, lending money, whatever the use is. We always teach that you put the money in and you take it out. So therefore, just by sheer nature of what we do, it makes the most amount of sense to have the most amount of cash value to use so that money can work for you. In an IUL, if I put 10 grand in a policy, and I have one I just had designed for me over in the other room, if I put 10 grand in, I have like $8,000 in accumulation value, which isn't bad. It's 80%. We can do better with a whole life because we can get up over to almost 90. But then comes the surrender value, the amount I can actually take out of the policy. It was $2,200. So I put 10 grand in and I've only got $2,200 to use. How can that work for the infinite banking concept? It still could be used because you got 2,200. You could take that and pay down debt, but wouldn't it be better to have 8,500 of the 10,000 to take out and use? It'd be much better. You'd get there a lot quicker and it wouldn't take as long. And the other thing too is there's unknown risks with IULs. And some people say, no, there's not. It's got a floor. It's got a floor because you're participating in an index. So you're not actually buying the index. So yes, they put a floor. Let's call it 0. But that doesn't mean you're not losing money. If you go to the floor, like if there's a down market year like last year and you're at 0, you actually did lose money because there's fees and there's cost of insurance that comes out of that. So no matter what, you're losing money in that equation. If your index is doing really well, could you be making money? Yes. But the way they illustrate them, which is why they've constantly been under scrutiny and why there's been multiple regs that have been put out against them, is because the returns they're showing the public are not likely to happen. So they give a hypothetical return, 7 or 8%. That's assuming that you make 7 or 8% every single year. That is not assuming that one year you have a negative year, the next year you have a 9% year, the next year you have a 2% year. It's not factoring in any of the drawdown effects or any of anything other than a level return. Now, have you ever seen any stock market index go completely like level in returns every year? It's the exact same return. Never, not once. Not ever once. And not only that, if you start off an IUL with a bad year, like what we've been going through now, pretty turbulent financial conditions, and you do your first year at a zero, you almost never recover, because you're illustrated to make 6 or 7 or whatever the return is the first year. When you make zero, like think of how much you got to make the second and third and fourth year. You got to double what they show you, or even more than double it, because you're starting from a negative balance, like a zero balance. They're just not the right vehicle to use for the infinite banking concept. Can they be used? Yes, but I just explained how you're going to use it. You're going to have a lot less money to use in an IUL than you will in a whole life. And I'm just brushing the surface, but I don't want to burn up an entire show on IULs. It's just, here's what I'll say about them. IULs were created for a specific purpose, such as supplemental retirement planning or any long-term use. They may be effective for that, but they absolutely never will be effective in the infinite banking concepts world. So if somebody wants to practice the infinite banking concept and use that process, an IUL would not be a good decision.
So when you're making your premiums into an IUL, are you making the suggestion that the paid up addition maybe shouldn't be done on those and just put your paid up additions into a whole life?
Well, so I'll give you an example. And the answer is truly, it depends. So recently I just started working with a client, and his wife has an IUL. And this very same question came up. The very same question of what you just asked is, should I put the minimum in or should I max it out? Now, his wife had diabetes and could not get another policy. She would never qualify for another type of policy. So therefore, and for anyone that's wondering what this little critter that just jumped up, this is, we call him Lazy Cash. He's our shop cat. He never misses a show, but he's always late because he's lazy. Don't let your money be lazy like this kitty cat here. So back to this client, his wife is uninsurable, but she has an IUL. And what he said is, he said, should we make the minimum payments on that because it's just not going to work for what we intended it to work for, which is the infinite banking concept? And I said, no, you should actually max that out. And you should call the insurance company that has your IUL and change the death benefit option to increasing. Because in that scenario where she can never get another policy again, she should be trying to get the most death benefit out of that policy, even if there's less cash value to use, because she just can't get it anymore. So I'd really have to go case by case to answer that, and to say, should they put the minimum in or should they continue to fund it at whatever the level funding is that it was built at? Most of the time, whatever it was built at is where you should fund it. Because if you go to minimum and you look at the guaranteed column, I can almost guarantee you the policy will lapse. Here's the final thing I'll say about IULs. You must understand that an IUL for an insurance company, they love them. They promote them. They advertise them. They teach their agents to sell them because they're a high commissioned product. But for the insurance company, they shift the risk from the insurance company to the client. The client is bearing most of the risk. How do insurance companies make money on insurance policies? You either live a long time and they get to use your money, or they know what the lapse ratio is going to be. They know how many of these policies are going to lapse, because either the policy, hits a point where it can't support itself, the client doesn't fund it properly, or the client just cancels it. That lapse is a win for the insurance company. A lot of people don't realize this. So when they shift the risk to the client makes a mistake of minimum funding an IUL, and then 10, 15, 20 years down the line, right when you need life insurance, or it becomes really important in your life, not that it ever shouldn't be important, but when it's most important, when you're a little older, then all of a sudden you start looking at the numbers and saying, I can't afford to make the premium payments that are required to keep this policy in force. Shifting that over to a whole life, that can't ever happen, because whatever you set the policy up for, that cost of insurance internally is level. It never goes up. In IUL, the one guarantee with an IUL is that every year you get older, your cost of insurance will go up. No ifs, ands, or buts about it. I know there's a lot of fancy terminology they're throwing around out there to try to mitigate what I just said, but the fact is, you get older, your IUL gets more expensive. So either you make more of a return or you fund it with more money. There are only two variables that play into that, both of which are on the client's shoulders, not the insurance companies. The whole life, 100% of the risk is on the insurance company. It's a guaranteed contract with guaranteed interest rates, with guaranteed death benefits, and a guaranteed level cost of insurance.
Well, I think that you just made my decision for me. So I will be looking at, because all of my children have one. So I want to get that with you as soon as possible. So how long, I think you didn't answer the exact question of how long does it take, like as soon as you make a deposit, when can you pull a withdrawal right back out?
Oh, I did. And that's the
Or no,
easiest.
sorry, not a withdrawal, not a withdrawal, a
A
loan. When
loan.
can we make
Yes.
a loan?
Oh my gosh, I got sidetracked because I think I heard withdrawal. I'm like, no, 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 you're
I
taking
know,
loans.
I'm sorry.
In any policy that we design for our clients, you can immediately take out your first loan within the first 30 days. So it just depends on the insurance company. But as soon as your check clears and the money posts to your policy, that money's available. You could go online, you could call your mapping specialist, and you could take that money out immediately and have it start working for you.
Okay.
So always immediately in the first 30 days. It will never take longer than that.
I know that that is a huge question with the audience that I have. So I know you just answered a big one. And I think that the last one that I have that they were asking me last night, because we did a live and you were all over the live. I don't even know if you saw that. Are the deposits that you put in, is that tax deferred? And can you put your whole check into that? Like if I make 5,000 a month, would I put my whole check into that if I wanted to turn around and bring it back out to use it for velocity banking?
Great question. So the answer is no. The insurance company would not allow you to put your entire check into the policy. And typically the insurance companies, depending on which ones, will allow 20 to 30% of your gross income. And that's all household income. So both spouses, both, whoever's in the household, they would allow that number to be used. But you can't put all of your money in. And the insurance company, if they found out you were, then that would pose a problem. So the reason for that is you should never use a whole life or this concept, the infinite banking concept, the process. You should not use it to pay your regular expenses. You shouldn't use it to buy groceries, make your credit card payment. You shouldn't use it to pay for your utility bills. Now, if you read the book, Becoming Your Own Banker by R. Nelson Nash, he said the goal is to get 100% of your income through the policies. That's the goal. It's a very hard goal to hit. You can with different structuring and layering through trusts and also through entities, because you can own a policy personally, and you can own a policy in your business, and you can own a policy in a trust. So the owner could be you personally, it could be a company as a corporate entity. They call that COLI, company-owned life insurance. It could be a trust-owned policy. And heck, I mean, banks are the number one purchasers, and that's BOLI, bank-owned life insurance. So the bank owns it. But the important thing to know is when you put money into the policies, you can take that money out immediately. But we want to take that money out and make it go to work for us again, because the whole purpose of the infinite banking concept and using the specially designed whole life is not to put money in and take it out to pay expenses, but it's to put money in and then take that money out, because our money never actually leaves. So it's still working for us. Take that money out and have it work for us again. So a great example would be, one of the things we always talk about is debt reduction. Now, I love what you do with velocity banking, because you show people how to pay debt down. And I think there's a big differential, which we'll cover in another video, between, velocity banking and the infinite banking concepts. A lot of people want to make them one and the same because they really are two peas in a pod. But you have to understand, velocity banking can be used by somebody that might be living paycheck to paycheck, that has good credit. Infinite banking requires our clients to have the ability to save at least 10 times their income. So you can see there's a big difference there. But let me get back to that example. I put money into the whole life. I immediately take that money out as a loan and I pay down a Visa. Let's just say I have a Visa that I'm paying 29% on, and it's $100 a month, my minimum payment. I then pay Visa off with the money from the policy. What I would then do is take that $100 a month that I used to give to Visa, which represents 29% interest, and I change where that money goes next, and I put it back into my policy as a loan repayment to the policy. What that does is brings down the loan balance, reduces the amount of interest the insurance company is charging me. Again, sounds very familiar to velocity banking when it comes to that. But what I did in that equation is I got to make money twice. As long as the policy was built right and is in its efficiency zone, I got to make money twice. My policy made a spread. The amount that I earned minus the amount that the insurance company charged me, spread number one. And every year that spread goes up because of compound interest. And then I made money a second time because I recaptured and recycled the money that I used to give away to Visa. That money now comes back into my policy. The problem I think a lot of people have with that is they don't realize that when that $500, or I'm sorry, that $100 a month comes back into the policy as a loan repayment, that $100 is immediately available when the check clears because it's going back into your policy, which is your banking system. So therefore, I think that's the best way to differentiate how to use it. The money, just always think, if I put money in a policy and I want to take that money out, I want that money to go out and work for me. I want that money to go out and earn an interest rate for me, whether that's paying off debts, buying a car instead of financing a car, lending that money out in private money club, or investing that money. I mean, some people love the stock market, so they could put money in the policy, take a loan from the policy and buy their favorite stock. And now they're making money twice, hopefully making money twice, not losing money in the stock. So I know I went in circles there, but that's a simple way to say it.
No, I mean, you have answered so many questions, even for myself. That literally was all that I kept getting asked last night. I wanted to ask you, so I just knew that you could clear that up for us. And it does make so much sense. I mean, when I think about infinite banking, I love it as much as I do velocity banking. And that's why it's such a big part of what I teach, is because I feel like people need to really consider moving on into these policies for investment, wealth, whatever you want to consider it to be, as far as putting your money somewhere where it's going to be growing continually while you're using it again. I absolutely love that. Wanted you to share that. I'm so glad you did. I cannot tell you how appreciative I am that you came on here to show us and explain this to us. And I hope that we hear more from you in the future, because I know I'm going to get more questions. So thank you, Chris. You're just awesome in every way.
It was my pleasure. And I love what you do too, because, we really can't help everybody. If somebody can't save money, then it's hard for us to help them. And I don't ever want us to, have somebody start a policy that's too premature and then they can't continue it. Because remember, I said how the insurance company wins is when people lapse policies. So we always want to try to put people in the right scenario for the right problem that they have. And velocity banking, I just think, is a perfect strategy to help the clients we can help. But also it's so similar to infinite banking in so many ways that it's just such a natural progression. Right. I mean, velocity banking changes the way people think about money and allows people to see how money really works, so that when they kind of learn from you, it's a natural pathway for them to next move into the infinite banking concept. So thank you for all that you do, because our clients also need what you teach and definitely need your guidance.
Well, I appreciate that. And it's all about helping the people. I do know that I personally use my HELOC. I use my lines of credit when I'm going to make deposits into my infinite policies. And that's going to be another video, I know. But that is a real case scenario that I use every year. And I want to share that with people soon, so they understand that once we're out of debt, once we have the cash flow, it is absolutely no problem to fund these policies, is what's beautiful about it. So we're really taking action. I mean, we're literally killing 3 birds with 1 stone. When we are wiping out our debt, we're saving our money, and we're pulling it back out, and we're using it again to invest in ourselves again. It's just a beautiful, everything to do with the infinite and velocity bankings are beautiful concepts that I don't think most Americans know about. So that's what I'm doing, is pushing the word, because I am hoping that you guys out there watching are listening to what he's saying. I know you're listening to me. I get your comments. I get all of these testimonies where you guys are really finding peace in your finances, which is all I want for you. And now we're going a step further, and we're showing you how to make a real difference in your financial future now that you're ready to tackle it. So thank you guys for joining us today. I look forward to seeing you in the next video, and I hope you guys have a terrific week. Thank you, Chris, for being on the show.
You're welcome.